Welcome to the 2024 Economic Depression and Preparation Channel. I'm your host, Tony. Thank you for joining me on this last day of July 31st, 2024, Hump Day Wednesday edition here. Please be sure to subscribe to the latest interpretation of financial news. I'm not a financial advisor, but I do interpret financial news so that you can make the 100% best decisions that are upcoming here for your financial future. Today, as you know, the Federal Reserve Bank concluded its two-day meeting, and they had a conference about 2 or 3 hours ago talking about leaving the rates unchanged. However, rate cuts are imminent in September. As Powell says, according to CNBC.com, rate cut is on the table, and this is an if-then condition if inflation data continues to cool. Now, we all suspected that this would be the case, and it's also that inflation data will continue to cool according to the official numbers. Now, we know the unofficial numbers are higher, and we do know that inflation is still persistent in food, utilities, transportation, and input costs for employers to employ workers. Now, but that being the case said, it's possible that, yes, they could do a rate cut. But the question then becomes, how much of a rate cut is Fed Chair Jerome Powell and the advisors willing to go? Most right now looking at a 0.25 basis point rate cut, possibly 50 basis point, depending on how things go. But once again, this is dependent upon if the inflation data continues to cool. The thing that's going to be the big question too, ladies and gentlemen, is that unemployment. A lot of companies are forced to lay off some staff, not all staff. It's not doom and gloom, but a lot of these mid-sized corporations and small corporations and businesses have laid off some people. And so because of that, we're going to see an acceleration or increase of that. And so if the unemployment rate continues to rise and price pressures continue to go, like I say, gas goes up before the elections and everything goes up, then that can pose a big problem. They may hold off on rate cuts, and we could have things unchanged. Rate cuts, and we may leave it unchanged again, and that'll put us into 2025 almost, where we have a situation where things could be really, really interesting coming up here. So this is very interesting, ladies and gentlemen, because this means that businesses are spending more. Consumers, as you know, we're all spending more, but we're getting less for our dollar here. So even though they're painting this rosy picture of inflation coming down over the year, we know that the real economy, the real U.S. economy is hurting on Main Street, and that's everywhere, from the Northeast to the Southeast to Midwest to West. People living overseas are hurting because everything right now is based on the U.S. dollar being the world's reserve currency. And so the dollar is stronger around the world, yes, but it's taking more dollars to buy goods and services and products. And since we don't manufacture anything in the U.S. that much anymore besides debt, fast food, and car washes and things of that nature, gas stations, you see those popping up, and storage units places, you see those new things popping up. That means, ladies and gentlemen, that this rate cut is not going to have less. It's going to have less and less effect on us in terms of our purchasing power. So it's critical that all of us continue to save money, continue to spend money on necessities, food, security, water, antibiotics, things of that nature, because there are going to be supply shock shortages, I believe, coming in next year as everyone realizes what's happening. Now, Bank of Japan raises interest rate to 0.25%. Open to further rate hike this year. So they're going through stagflation here in Japan and other places. They got to raise interest rates. So it's possible that the Bank of England and the European Central Bank and the U.S. will follow later on this year once they realize that inflation doesn't cool as much as they think it will. So we'll see. We'll just have to wait and see how things go as well. Now, also, private sector job growth slows in July to just 122K. Here we go again. This is worse than expected. This is Fox Business. This is a major business channel, Fox Business Channel. They're reporting that, and this comes out with the Bureau of Labor Statistics. So once again, ladies and gentlemen, we can see that not just the public sector, not just the Magnificent Seven or the big companies are laying off people, or either reducing staff pay. Private sector job growth slows to just 122K. This is below the estimate. We had 200,000 jobs, as you remember, added in May and June in terms of the public sector jobs, right? Even that's kind of paltry compared to the overall labor force. Remember, we had a lot of college graduates coming out in May and June. We've had overseas workers coming over here and that needed jobs, from H-1Bs and all kind of stuff. Engineers, scientists, these are professionals, white collar jobs, blue collar jobs, tradesmen. So this is not a good sign when we see that Unemployment rate is rising above 4.1%. Once unemployment rate gets 5% or 5.5%, look out. Things are heading toward recession territory. Now, the good news is that these companies are still hiring and they hadn't passed their buck on too much in terms of raising, our healthcare costs and stuff like that. But the bad news is that things is really going to be interesting because job growth is slowing down. So just something to look forward to. Now, on Friday, we get the job growth, the unemployment data. We're going to see if that raises or not. Let me know in the comments what you think. Do you think unemployment is going to raise, or do you think it's going to remain the same? I think it's going to rise up to 4.5%. Let me know in the comments what you think, and that'll be a key sign of what to do, what to expect in November, December of this year. Thank you for listening. I look forward to hearing you on the next video. Blessings. Take care, guys.